Paul Andriola. Not only have I helped put on this conference, but I'm also the CEO of a company called NameSilo Technologies. We trade under the symbol URL on the CSE and URLOF on the OTC. That standard disclaimer everybody loves. Okay, what is NameSilo? So NameSilo, really, we break the business down into two components. The operating side of the business is a company called NameSilo LLC. It's one of the world's fastest growing domain registrars. I think we are now officially in the top 10 out of close to 3,000 domain registrars that are out there. So if you know GoDaddy, you kind of know the business we're in. So that's where we generate our cash flow, and that's been growing nicely since we acquired it. But the second part of the business is we take that cash flow and we reinvest it in other opportunities, everything from private investments to public investments, and then recently, as a matter of fact, today, with the official closing of SewerVUE, we acquire 100% ownership of other businesses as well. Okay, so a little bit more of a breakdown here. Of course, we own 100% of the investment portfolio, but the operating business, we actually own 81.5%. The other 18.5% is owned by the operating team. And this lines us up nicely with that operating team who have direct incentive on growing that business. And I'll show you what that means as far as since we've acquired it. Okay, so when we purchased this, I think it was 2018 or 2017, I can't remember the exact date, but we acquired it for roughly just over $12 million US. Since then, we've seen distributions of approximately, 22 million Canadian, almost 23 million Canadian, distributions back from the business. And in Q2 alone, operating cash flow was just shy of 2 million US, approximately 2.6 million Canadian. And you can see what it looked like for the first half of the year, just over 5 million Canadian. So the company's cash flowing very, very nicely right now. Okay, a little bit about the domain industry. Hopefully everybody knows what a domain is. We operate in what we call the discount part of the market. I like to break the market down into three components. You have the GoDaddy of the world, which is by far the behemoth, and everybody knows that company because they spend upwards of $500 million a year just in marketing. And there's nobody else on the planet that can compete with their marketing spend. Then you have the mid-tier businesses, some companies you may know, Name.com, Two Cows, for example, is another Canadian company. These guys operate more or less with a legacy business model. They're not the cheapest, and they don't have the marketing spend of a GoDaddy. And then you have companies like ours, NameSilo, where we operate we're the Walmart of domains. And we sell our domains more or less cheaper than anybody else. What that means is we spend a lot less on marketing. A lot of our business is really driven by word of mouth and a lot of repeat business. And we tend to get a lot of people who used to shop at GoDaddy. Once they see that there's an alternative for the exact same product, they switch to providers like NameSilo. Okay, so currently we have roughly 5.8 million domains under management. We've grown that count by over 200% since we acquired it, and have a run rate revenue right now, or rather a trailing 12-month revenue of $61 million. And we are one of the fastest growing domain registrars on the planet. So when we originally bought the business, it was just domains. They only sold domains, no other services. Since then, we've added ancillary services such as hosting, security, email, logo making, and just very recently, a website making product. What I should say is those products there that I just mentioned are significantly higher margin than the original domain sales alone. Okay, so this chart, you'll see what's happened since we acquired it in, 2018. More or less every year since we've acquired it, we've seen a significant increase in revenue and a 5-year CAGR of roughly 16%. The growth in domains has been the major reason for the growth in revenue. As you can see over time, we've managed to continue to grow our domain count and almost 12% CAGR. Yes, so consistent growth in domains equals growing recurring and reoccurring revenue. The really nice thing about this type of business is the majority of that revenue is recurring. So somebody who buys a domain, that domain contract is typically good for a year. At the end of that year, if they do not renew their domain, it goes back into sort of the pile and they lose it. So the majority of these domains are repurchased every year. We really measure our business by bookings. Bookings is the cash value of the business that we're getting. And again, since we've acquired the business, the bookings continue to go up. This is an interesting business. We get paid up front for our product that we sell. We deliver that product right away, but we have to, for accounting purposes, we have to accrue that revenue or amortize that revenue over the course of that year contract. So the revenues don't necessarily always align with the bookings. Now, this is my favorite chart here because what this business really does do is generate a lot of free cash flow. There's a lot of things that we write off in terms of non-cash costs and accounting expenses, but the cash generation that this business generates is outstanding. Just in the last half of the year, as I said, over $5 million in free cash flow. Okay, so the next big question is what happens with that cash flow? So originally this business was an investment holding vehicle, and we had made some investments in some companies that where we took the advantage of sort of the private-public arbitrage. We would invest in companies that are going public, and we're able to generate some pretty sizable returns on that portfolio. But now we're able to really supercharge that with the cash flow that we've got. So we operate in sort of well, we call it a sweet spot where it's not quite big enough for a lot of the private equity that's out there. And these are not typically startups. We are looking for businesses that are a little bit more commercialized. So our typical business that we're investing in is kind of in that $2 to $20 million valuation or market cap size. And we have a very, very robust pipeline of opportunities. So we say no very often, but that's because we have a lot of opportunities to look at. Just a little example of some of the companies that we've invested in. Atlas Engineered Products, which is the company that's here right now. Even though the stock is down from its high, our early investment is still up almost tenfold from when we first purchased it. Alchemy, another company that's presenting here today. We are a significant backer and likely, outside of management, the largest shareholders of that company. Chillcare, which went public just several months ago. We were investors in the pre-IPO round and are up sizably on our investment there. Ola Media, another company that's presenting, sizable investment there. Allure is still a private company. Our original $75,000 investment based on the last financing round is now worth $750,000, so we've done well there. And then the last company, SewerVUE, which is a company that we officially acquired today, that's a company that we're super excited about, and I'll get into a little bit here shortly. Management team, myself, I've been doing this now, or the head of the company for about 10 years, but my background is, I was an investment advisor, investment banker, and private investor now for a number of years. The team, Christoph Zronka, the operating CEO of the domain business, he's had a very successful exit and brought his team back to run LLC. Colin, who's my co-director who's here, Paul Kozak, another co-director that's here as well, both with venture capital experience and capital markets experience, so helps with deal flow and deal vetting. And Tash, my CFO, who's been at this for probably 20 plus years. And then our most recent director, Dan Milich, who has got significant banking experience and is now helping us with due diligence on a number of deals as well. Okay, so just a cap table here. As you can see, 88 million shares outstanding, roughly 7.6 million in options and RSUs outstanding. Share price is last, I think it's around 155-ish, 157. So market cap of 138 million. We do have as far as debt, we have a promissory note worth about $500,000. But we have excess cash. So on a net basis, we have about $3.5 million in cash. We do carry Bitcoin on the balance sheet, but I want to stress that we are not Bitcoin investors. Bitcoin is a payment method for the domain business. So from time to time, we have an increase in Bitcoin on the balance sheet, but roughly once a quarter, we convert that into cash. Investment portfolio right now runs at roughly about $5 to $5.5 million in value. So you're looking at enterprise value about $128 million. Okay, so going forward, really the thing to understand is we have access to cash, and with that cash, we've done a number of things in the past, and we'll continue to do that. One is we have been very active on a share buyback. So we've managed to buy back about 4 million shares over the past 2 years or so. You'll see the investment portfolio will continue to expand. We will continue to look at opportunities to deploy that cash. We are actively looking in the private to public arena where we know there's significant opportunity. And we actually think now the timing is probably as good as it's been in the last 10 or 15 years. There's there's almost a shortage of good quality public companies, especially in the microcap space. And you're starting to see more listings. I'd say up until about 6 months ago, you saw very, very few new listings because there just wasn't the appetite. We have the ability to fund these things and take them public. So we think that the time is right for those sort of opportunities right now. And then we will continue to look at opportunities where we can add services and product offerings for the domain business. We've made a couple small acquisitions here in the last couple months that we expect will have nice impact on our domain business. So that's it in a nutshell, but I want to talk a little bit more about SewerVUE. SewerVUE is sort of an example of the kind of opportunities we're really chasing now. It's a company that we've been in discussions with for probably about 3 years. And what they do, if you've had an opportunity to see outside, we've got one of their units in the lobby. They provide robots for sewer inspections and predominantly what's called large diameter pipes. This is a very nasty environment. You can't get human beings into this. You can't shut these things down. So robots are the perfect answer. And traditionally, the way these are inspected is using CCTV cameras put on a float or in another device, and they're let loose down there. The issue with CCTV cameras, well, there's a number of issues, but you can't see anything under the water line. That's a big issue. And a CCTV camera doesn't tell you the thickness of the wall, or in a lot of cases won't pick up a lot of the cracks and the voids that are either in or around a pipe. The model that we have out there has a CCTV camera. It has a sonar, LiDAR, and radar. So you get a significant amount of robust data that somebody can make some real solid decisions on. And we've got an aging infrastructure, so the demand for inspections is growing. This is an interesting opportunity that we were able to acquire based on a relationship that we built up with the company over 3 years. It was an interesting circumstance because the owner was in his early 70s, and originally we were looking at helping the company go public. But the owner in his 70s said, okay, it's going to take 3 to 4 years for this thing to go public. 3 to 4 years in totality before I can actually sell all my shares. And he said, look, if you make me a good cash offer, I'm willing to act on it right now. So that's what we did. We acquired 100% through NameSilo. The reason we were attracted to it is the economics are like something I've never seen before. These units cost about $100,000 to $140,000 to build, Canadian. We just sold that unit that's out there for $400,000 US. But the data processing is where the money is really made. So the average unit like that is in use is going to generate between $60,000 and $90,000 a month in data revenue. Right now that runs about 80% gross margin. We think we can get it up to about 90, 95% with a little bit more tech work. And we think we can get the costs of the units right now down from about $140,000 to as little as $80,000 to $90,000, depending on a few things. So when you do the math, the payback on these units once they're up and running is about 2 months. And there's significant demand out there. So we think there's potential demand for at least 100 of these units in pretty short order. So when you do the math, you see some pretty robust numbers. Now you're probably asking, why didn't the past management do this on their own? Because the owner had to take all the, any profits out of the business he had to take just to keep his lifestyle going. So we're in a position to properly capitalize this business. My goal is to see if we can't just give these units out for free and just generate the recurring data processing revenue and lower that CapEx. And that seems to be the big sort of detriment, or the reason why a lot of these service providers aren't actively, aggressively buying these units. So we think we've got something here that could really change the dynamics of the whole business, and we're going to be very aggressively capitalizing this business to go after that market. So that's a little bit on SewerVUE. If you want any more details on SewerVUE, Nick is outside and would be happy to answer any questions.